got that G, got my nullos. I'm just saying. We pull up to the scene, they be filled with jealousy. If a bitch get
stop
finicky, she gon' bring the energy. I hit a phone with a
3, 2, 1, action.
Dear light.
I got chills, then multiply.
So hello everyone, it's Harvey and I'm back for yet another video, and I hope you guys are having a great time and welcome back to my channel. Whoo guys, let's go. We are talking about option trading, and I just wanted you guys to know that I was trying to just speak slowly because I'm discussing with beginners, right? When you're watching this video, it's because I'm seeing it as a beginner, because when I started I had to study for 3-4 days all night just thinking about this situation because I'm new to it. So now I have an idea, I'm trying to share it with you guys, okay? So the next title I'll be talking about is covered call option strategy. Now there are so many terminologies when it comes to option trading, people. Woo child, I'll be like woo, I'll be like woo, 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 woo. So let me break it down in the best way I can. First I'll read this the way it's, you know, explained, then I'll show you guys what I think about it.
Yeah, girl. Oh my God. You know, clearly you need to relax. Well, don't. Woo! Just sit down. Now, come on. All right, Vant. Come on now. It couldn't have just kicked in like that.
Oh Lord, my pressure.
So it says a covered call option is when an investor sells a call option while holding the underlying stock position long. Here is an illustration about it. So what that means is that in order to sell a covered call option, you have to have 100 shares of that stock from that company. That's what it's called, underlying stock position, or underlying equities, or underlying securities. Sorry, underlying securities means stock. That means you have 100 shares of that stock company shares, okay? That's what it means. Okay, so they said a covered call means you're holding the stock, but you have to have up to 100 of it in order to indulge in option trading of a stock. Okay, now the objective is that the investors can actually utilize this by collecting premium for the sale of call options. So I buy puts and sell covered calls. That's why I know this one very well, because this is what I do. Now the maximum potential loss is the entire value of this stock less the premium received. In other words, from the option sale. In other words, the covered calls limits the upside potential of the stock during the duration of the option. All options have an expiration date. Now this is because the option seller has the obligation to sell the shares to the buyer of the option at a particular price, also known as the strike price. Therefore, an investor who seeks a covered call strategy may have these shares sold at the strike price, but may no longer participate in any future stock price increase. Now, an investor who has a neutral to slightly bullish outlook that does not anticipate this price of the stock to exceed beyond what they've already bought it, can actually utilize this call option strategy to increase returns.
We're gonna get into some technicalities here because you know they always gotta come with the receipt.
Now, I would explain this example in the best way possible. So, I bought a stock at $10. I have 100 shares of this stock at $10. Now, this stock may have, let's say, depreciated to $8 or $7. I'm like, okay, you know what? I am now putting up a call option for $10. Or let's say I'm putting up a call option for, let's say, $13 or $10 or $9, and I'm saying this stock has gone down to, let's say, $5. I'm saying, okay, if this stock comes back to, let's say, $9, then I'll buy, then I'll sell it to whoever buys it. Now someone is like, I'm sure this stock will go to 9, 10, 11, 12, 13, 14, even $20. So they would buy an option for me, the option, the contract I've written, they will buy it for me. Like, okay, if this stock comes to $9 or $10, I'll buy it back from you at this price. So here you go, here is an advance, a premium. So I, who is selling this stock, who is writing this contract, is like, okay, I have to hold an advance, which is the premium. They may pay, let's say, $2, as my premium, or $20 as my premium. Remember, it's representing how many shares? 100 shares per contract. Now I'll hold on to that premium. Now, if this stock does not get to $10 in the stipulated time amount as my contract, because it always have an expiration date, then the person who buys this contract from me would lose the premium they gave to me, so I can keep the premium. But if this stock comes to that $9 or $10 that I have stipulated, I have no choice as the owner of the stocks to sell those stocks at the price of $9 to that person. Now what happens is that the person can now go about their day. They now have my stocks from me. I have now lost my position from that company. Now what will happen to me is that I would keep the premium, but I've lost my stocks at a discounted price. So it helps you to reduce the depreciation or loss from a company. Okay?
Wait a minute, who am I? That's a Raven moment.
Now, another instance is I bought my stock at, let's say, most times it's always below, but I bought my stock at, let's say, $6. Okay? I can now put a strike price at $8 call and say, because I have, my hope is that it doesn't get to $8, but if it does, then I'm out. I have no choice. So the person who buys the stock, this covered call from me, is that, okay, if it gets to that point, I would personally buy it at that price from you. Then we write an agreement. This person buys, they will have a debit from their account. I would have a credit to my account because I now have a premium holding a premium. So when this person, if it gets to now that point we've agreed upon, like, okay, this is the price, what would happen is that this person now has my stocks, but at a higher price. So any future profits goes to them because I'm now out of the position. They now have my position. It's like having a house, then you sign the lease and give it to someone else. Like, okay, from henceforth, this house now belongs to you at this particular price. So any more profits you make, it's all yours. You see? But I have now lost it. So my goal when I sell this is hoping that this stock does not come too high to that strike price, so I can keep the premium and still reduce my depreciated value from the stock. So you do this mostly when your stocks are really in the red and you're just trying to minimize the loss, the unrealized loss you're seeing. Okay, that's when you go for covered call option strategy. So I buy puts and I sell covered calls. Okay, so look at the graph. What you see there, it shows you that premium. You see, your profit you make is it has a limit. But the person now who buys this stock, once they've gotten the stock now, any more profits, if it goes to $1,000 a share, they get that profit. But you're now out of the race.
Him now.
So the maximum profit per option would be the strike price minus the stock purchase price plus premium times 100. That would be the maximum profit. Then the maximum loss would be the stock price minus the premium times 100. That would be, so the maximum loss is the stock price less the premium received multiplied by 100. That would be the loss. Okay, the break even is when you make no money and when you don't when you lose no money. So it will be the purchase price of the stock less the premium received. That will be the break even. So let's see the example they have here. They said if stock A trades at $14, trades up $14 and above, the investor would make $600, which is made up of $400 of the stock appreciation price plus $200 from the sale of the option. Conversely, the maximum potential downside is the risk of $800 because this is comprised of $1,000 of the loss if the stock price goes to zero, less $200 premium made from selling the call. Good. So if the price of the stock exceeds the price of $14 during the life of the option contract, the investor could potentially be assigned and obligated to sell his $100 shares. Why do they always say his? They, there are days, there are has, there are wow. So while the investor realizes the maximum profit in this situation, the 100 shares are no longer held long. You see, that's what I'm saying, you're no longer in the company. So if, however, the price remains between $8 and $14 up until the expiration date, because remember the person bought this stock at 14, okay, the investor will receive a profit greater than had he had held this stock and not sold a call. In this way, investors can make a greater return selling covered calls in a rising bull market. The potential downside risk is if RAR ends up below 8 by the time the option expires. In this scenario, the investor will be left with a loss. However, the investor offsets a portion of that loss from the stock decline with the premium received from selling the call option. That's what I'm saying. So if you sell a call, okay, what happens is that if the strike price is not met, the person who buys the call from you would have a debit. You selling would have a credit premium held. Now when it gets to that strike price, you want it to be in the money, because if it gets to the strike price, the stocks goes to the person who bought the call from you. Okay, now the person who buys the call from you wants the stock to appreciate to $10 or to the price, so that way they can take the stocks from you. The person who buys the premium from you, buys the option from you, they don't have the stock themselves. You, the seller, you're the one who owns the stocks. Okay, so it's like you're betting your stock, like, hey, I have this 100 shares. If it gets to $12, $13, I'm willing to sell it off. But the person who buys has a premium to be paid to you, so you're holding that premium. If it doesn't get to that strike price, you keep the premium and your stock. But if it gets to that strike price, the person keeps your stock, okay, at that price. So after that, after the expiration, they will have your stock. Whatever profit that comes afterward, they can keep it or they can sell it at a higher price. So whatever comes after that, it belongs to them now. But you're no longer in the race. If the stock appreciates further, you've lost out on that. So your profit margin is limited, it's fixed. But that person has a great deal, okay? Because you really did not believe in the stock. This person believed in it. So that's the best way to describe it. So the potential downside is, but if the person now, after the contract is over, that stock goes to zero, then the person who bought the stock would incur that loss. But you've already reduced your own loss or profit. So your profit is fixed and your loss is kind of fixed too. No, your loss too. So if it goes all the way to zero, then let's be real, you know, I think that's self-explanatory. I love you all so much and I cannot wait to see you guys soon in the next video. I'm from Salvador and Upside Studios. I'm here to hang out with you guys, okay? Bye guys.
Cause I'm loving myself real good. Did you guys hear that? I'm scared. In a way that you never could.